What's going on, YouTube? Today, we're going to do a basic stock video on how to look at stocks and what is a good stock and bad stock by using examples and using the internet by doing basic research. Now, I'm going to look up on the article saying, hey, what's the top 10 stocks to buy in 2026? And before you believe them, this is what I do to see if they are worth purchasing by looking at these few items. And we'll go over this in this video. So please like and subscribe to this video. It really helps with the algorithm. But let's get into this video. I'm YB and I spend ungodly amount of time looking at stocks. I think my stock portfolio has done 40% return this year, but that's beyond the point. How did I get there and how did I do it? Well, by not believing what the internet says. I do my own due diligence. I'm a value investor and I make sure each one of the stocks I purchase is in good financial standings, pay a dividend if it's going to my dividend portfolio, and has a good future outlook on them. So let's go and look at this article. I Googled and this came up 10 of the best stocks to buy in 2026. And here are some of the stocks that they recommend you to buy. So before you go out and try to buy every single one of these because this company recommend you to buy them, here's the thing I got to tell you. You always have to do your own due diligence. Let's go into this first one. Consolidation Edison Inc. So ED. Now, I just click on it and see how they've been doing. Now, personally, I like to see what the company is because if I don't understand the company, I will not purchase the stock. If I can't explain it to a 2-year-old, it's too complicated and I just can't buy a stock that I don't understand. You lose money that way. So that's the first thing. So Consolidation ED Incorporation. What are they? Well, they invest in electric and gas transmission project. So let's see how well they've been doing. So I like using MSN. You can use any platform you want, but let's go to MSN. So now we're on MSN, and what do I look at? Well, I look at the growth rate of this company. See if they've been growing. Year to date, it grew 13.98%. 1 year, it's 10.29%. 3 years, it's 24.92%. And 5 years, it's 59.57%. It looks decent. It has good growth opportunity. So these are the things I look at. It does pay a dividend. So maybe I will add this to my dividend portfolio. 3.18% dividend yield. But before I do all that, I know what the company does because I read about the bios. You need to do your due diligence more into this company to make sure it's something you want in your portfolio. Then you have to go and look at the finance. How well have they been doing? Well, you want to look at the revenue. Has the revenue been growing year over year? Yes, it has. And then operation expense minus operation income to see what the net profit. They are in a positive net profit, 11.96%. So yes, this company does have a good profit range. So it's making money. So then you want to go on the balance sheet to see if it's doing well, if it's increasing the long-term debt, which it looks like it increased the long-term debt almost every single year. That's something I can't get into because they're putting themselves more at risk. I like to see a company personally lower their long-term debt over time. And you see right here, it increased in the last 4 years. So why would I want to invest in a company that keeps increasing their debt? Now, you want to look at the cash flow. Have they been cash positive? So the free cash flow, almost every single year besides last year, it's been a negative cash flow. 2024 has a negative 1.16 billion. So personally, when I look at this income statement, the finance statements, this is not a good company to purchase because the value it has in making money. It looks like it borrows a lot of money. So that's basically how I look at it and research what to buy. I also use AI and everything else, but once I get to this point right here and I see that they're not doing so well with their cash position, I don't even continue on with it. So let's go on and look at another one. W.R. Berkeley Corporation. Now, remember, this is I'm looking up stocks and the best stocks to buy in 2026. Do I agree with them? Let's see. WRB. WRB. So WRB. Let's look at these numbers real quick. And first, what is WRB? So if you want to know, on the company website, it tells you what it does. It's a insurance holding company. So it holds insurance, it deals with insurance. So that's the basic. You can go more in depth of it, how they do it and what they do. This is just a basic video on how I find stocks. And then personally, I like to see what it does year to date, 1 year, 3 year, 5 years. It looks like it had great growth over the years. But how does their finance look? Finance. Well, they've been growing year over year, so that's good. And their net profit's 12%. So on the books, it looks like they make money every year. But let's look at the balance sheet. Their long-term debt has not went down at all in the last 4 years. And it's not moving. So this is a red sign for me not to buy it because they're not paying off their debt. They're just holding at $2.84 billion. From 2022 to 2025, they did not touch their long-term debt or bring it down. So that's something I cannot go with. And then cash flow position. Are they doing better with their cash position? Free cash flow, 3.4 billion. Last year they had 3.5 billion and they used $100 million on something. In 2023, they had 2.87 billion in cash flow and they increased it in 2025. So the cash flow position looks good. It's in a positive position. And over time, it looks like it did increase. Now, here's the thing. I can't invest in this company because the balance sheet shows me they don't know how to handle long-term debt. That's just my personal opinion. Remember, I'm a value investor and everyone has their own ways to look up a company. So that's just the basic. Now, I do go into AI and see what else they do. And AI gives an evaluation of 0 of 6. So here's another red flag. Now, it does show that it's doing well. And it does pay a dividend yield. So it pays a dividend, but at the end of the day, I don't know if they can be able to keep up paying the dividend if they don't understand how to handle the long-term debt. Unless a major project came along that they have to borrow money and that'll be on the news, then yeah, I understand. They bought a power plant. They bought XYZ. They built out 10 facilities. That's whenever I expect the long-term debt to go up. But besides those times, the long-term debt should be going down, in my personal opinion. That makes me believe that the company has a good standing and has a good understanding of how to balance their books and how to handle their money. Now, let's look at CBH. They said they had a 34% return. So CBH. Now, Zimmer Biomet Holding. I know what they are. They're a biomed company that creates robots and creates medical devices. So, yes, I know what they are and who they are, but that's because I work in the medical field. So, if you don't know what they are, make sure you study and do your due diligence. But let's see, are they worth holding on to or buying? Well, the 1 year is a negative 10%. 3 years is negative 24%, and the 5 years is negative 40%. Personally, right then and there, they don't have any growth based off the numbers that is on here. So let's move on to the finance and see what their profit is and see if they've been growing. Well, revenue's been growing until 2019 and 2020 it took a massive hit of $1 billion. And in 2025, they finally got above their 2018 profit. So to me, it might be a good time to buy. It might be turning around. But I would like to see a few more years of good returns for their revenue because something could happen. Another company can come up and take another market share from them. So their profit range, let's see how they've been doing. Well, in 2018, they were in negative, positive, negative, positive, positive. So the last 3 years, they're in a positive 13.86, 11.79, and net profit of 8.57%. This part I will avoid because their profit margin is going down. And I can't buy a company that their profit margin is not stable or increasing. To me personally, there is no point on buying those companies because I am looking for companies that good value, that has good growth opportunity. So let's look at the balance sheet, see how well they've been doing. Well, here again, their long-term debt since 2023 has been increasing every single year. So no, I don't recommend you to buy them by looking at these financial statements because long-term debt's going up. Why are they pulling out more debt without being able to increase their revenue? So guess what? I'll move into cash flow. How has their free cash flow been doing? Well, look, it has been increasing, but they've been borrowing more money. So personally, for this one, I can't recommend either. So this is why I tell you, be careful when you read these top 10 stocks to buy in 2026. I clicked on 3 of them and none of them I would be able to recommend because the outcome of them I can't predict. They either have money problem by increasing their debts, they have bad growth over time, or they just have nothing going for them. So this is how I do my research on stocks. I'll use these articles to see if I find a stock that I want to buy. But this is why you can't believe every single news article out there. And this is one of the traps I fell for. Is I will go and say, oh, W Top News said I should buy this stock. And I'll just buy it without doing my research because it says it's going to be doing good in 2026. And this is why you should always do your due diligence because maybe some of these will do well. We can look up Fast. I do own this company because I believe that they're going to grow over time, but that's due to infrastructure and not anything else. And because I believe companies will be needing more nuts and bolts and everything else they offer. So, but look at the numbers, just like I did. In year to date, 13, 1 year, 20, 3 years, 77. It does pay a dividend because it's in my dividend portfolio. And finance, it stays around 15% gross profit or net profit. And every year it has grown its revenue. This is what I'm looking for. And the balance sheet, you notice that the long term debt is going down. This is a good example, one you should buy. And you look at the free cash flow, they stabled out around 1.05 billion, but they're paying off their long term debt. So, this is an example of one to buy. So, basically, I looked at four of these and only one I would recommend you to buy. So, be careful and understand that you need to pick your stocks and not believe what the internet tells you. So, like and subscribe to my video. That's all I got for you.